Hello everyone, welcome back to my lecture channel. So today we're going to be talking about money, banks, and the Federal Reserve System. So what's kind of interesting about this chapter is it really gives you some background context as far as what's actually happening in the economy right now, since the Federal Reserve has actually elected to cut rates and Congress has passed some stimulus as well. And so I just linked a brief article at the top of the outline that y'all can check out if you want. Again, we're going to be talking about monetary and fiscal policy separate in our chapters coming up. So just to give y'all a little bit of a teaser to what we're going to be talking about. But this chapter really focuses on kind of like the background information, making sure you understand money, banking, and the Fed itself before we kind of talk about the policy decisions. So the first thing we're going to actually be talking about is money. So this chapter is just going to briefly go through money and banking. If you're interested in that specifically, then I suggest that you would take a money credited banking class, which is actually offered through the College of Business. So let's go ahead and just dive right in. So 14-1, what is money and why do we need it? So obviously money is one of mankind's really most important inventions. Overall, economists consider money, it's going to be any asset that people are generally willing to accept in exchange for goods or services or for debt payment. So I went ahead and just defined asset for you here. It's anything of value owned by a person or a firm. So as far as what we're going to do is we'll start by considering kind of the role that money serves as well as what can actually be used as money. And then we're going to kind of consider some different modern forms of money and then the roles of the banks and the government in creating and managing money. So the final thing that we'll be doing in this chapter will be kind of creating a model related to like the prices and the actual amount of money in an economy. So the next thing we're going to be talking about is the idea of what happened before we invented money. So obviously before the invention of money, if you're wanting to trade goods, you're going to have to barter. You're going to trade the goods and services you've produced directly for other goods and services produced by others. And so eventually societies as a whole, they started using what's called commodity money. So what commodity money is, that's goods used as money that also have a value independent of their use as money. So kind of some examples of those would be animal skins, kind of during the colonial North America, you had the beaver pelts, you also had buckskin, and then also like precious metals. So here, obviously, silver and gold. And then some other examples would be like back in history, people used cigarettes. Like in prison, they could be used like prisoner of war camps as a form of commodity money. And so we'll kind of touch back on commodity money types just a little bit later. And I'll also throw some links on WT class as well, kind of talking about some other forms of money as well. So overall, the existence of money, it makes trading easier, right? And it allows for specialization, which is really important in developing an economy. So now let's go ahead and get into the 4 primary functions of money. So the 4 of those are it's a medium of exchange, a unit of account, a store of value, and a standard of deferred payment. So we're going to go through each one individually. First of all, as a medium of exchange, it's going to be acceptable to a wide variety of parties as a form of payment for goods and services. As a unit of account, it's going to allow for a way of measuring value in a standard manner. As a store of value, essentially money is going to enable people to defer their consumption till a later date by storing value. So like other assets can also kind of be used as a store of value, but money does it really well because of its liquidity, so it's easily exchangeable. Value. And then the final thing, or the final function, really prime function, would be as a standard of deferred payment. So what that does, it essentially facilitates exchanges across time when we anticipate that its value or purchasing power in the future will be predictable. So it's going to facilitate or make easier exchanges across time when we anticipate that its value in the future will be predictable. So when we're talking about what overall can like serve as money, in order to serve as an acceptable medium of exchange and have potential as money, a good has kind of 5 characteristics that we'll be kind of talking about. So obviously the good's going to have to be overall acceptable to most people. Obviously, people are going to be wanting to be willing to accept money in exchange for goods or services. Also, it's going to have to be a standardized quality. So essentially 2 units have to be alike. It's going to be durable enough that its value is not lost by wearing out. It's going to be valuable relative to its weight, so it can be easily transported even in large quantities. And then it's also going to be divisible enough so that it can be used for purchases of both low price goods and high price goods. So kind of returning to the idea of commodity money, remember the important thing about commodity money is the fact that it has a value independent. And so kind of Some other like kind of historical commodity monies would be cowrie shells in Asia. So these were used as money and currencies, and then also like the other couple examples I mentioned, which were the animal skins, the precious metals, cigarettes in prisons, used historically. So what happened over time, obviously, so we just talked about commodity money, but actually beginning in China in the 10th century and kind of spreading throughout the world, paper money started to be issued by banks and governments. So usually the paper was exchangeable for some type of commodity, kind of like gold on demand. But in modern economies, your paper money is going to be issued by the central bank, which is run by the government. So obviously for the U.S., we have the Federal Reserve Bank, which is the central bank of the U.S., but the money actually issued by the Fed, it's not exchangeable for gold. And so instead, it's kind of known as fiat money, which is any money such as a paper currency that's authorized by a central bank or governmental body, and that does not have to be exchanged, by the central bank for gold or some other commodity money. So quickly, I just want to make a note that the Federal Reserve is the central bank of the U.S. So the U.S. dollar is fiat money. And kind of when thinking about fiat money, it has both advantages and disadvantages. Overall, again, an advantage is you don't have to exchange it for gold or another type of commodity on demand. So it enables central banks to be kind of more flexible in creating money. However, there's some problems in the effect that essentially fiat money is only going to be acceptable as long as households and firms they have confidence that if they accept these paper dollars in exchange for goods and services, the dollars aren't going to lose value. So kind of the idea that households and firms must have confidence the dollars will not lose much value during the time which they hold them. So essentially, if people stop believing in fiat money, it's not going to be useful anymore. So kind of the idea of when a store kind of decides that maybe they're not going to take cash anymore, which was very prevalent when I studied abroad over in Scandinavia, so Denmark and Sweden. Essentially, like, you're going to, you're no longer accepting cash as a form of payment, and so, which is completely legal to do, right? As far as debt goes, that's a completely different story. But when they no longer accept cash for payment, you're really going to have to kind of look to, other ways to have an exchange. Obviously, the use of smartphones, Venmo, Apple Pay, anything like that. Samsung Pay has kind of facilitated, the switch from cash to using, an electronic form. So as far as how money is measured in the U.S. today, essentially what they've defined is two definitions of money. So we have M1, which is the narrow definition of the money supply, so sum of currency in circulation, checking account, deposits in banks, and holding of traveler's checks. And then M2 is the broader definition. It obviously includes M1, but it also includes savings account deposits, small denominations, time deposits, balances in money market deposits, and non-institutional money market fund shares. So kind of in talking about which type we're going to use, or which definition overall we're going to use, either one, M1 or M2, might be valid, but really we're mostly interested in money's role as the medium of exchange. And so kind of this idea suggests using M1. So kind of when we're talking about money, we're going to treat both currency and checking account balances as money, but nothing else. So traveler's checks are kind of insignificant anymore. And then we also need to realize that banks overall play an important role in the money supply, since essentially they're going to be controlling what happens to the money when it's in a checking account. So one more thing that I wanted to mention was the question about what about debit cards and credit cards? So essentially, debit cards directly access checking accounts, but the card itself isn't money. The checking account balance is. And then as far as credit cards go, obviously they're a very convenient way to obtain like short-term loans from the bank issuing the card, but the transactions, they're not really complete until you pay the loan off. So when you transfer money to pay off the credit card loan, so credit cards don't represent money. So again, we're going to be using M1. And then we also want to note that credit cards are not money. So kind of earlier these past couple of years, when the concept of cryptocurrency or Bitcoins kind of was very popular in the media, like one might wonder, are Bitcoins or cryptocurrency, is that money? Typically, obviously, we're going to be thinking about money as something that's going to be issued by the government. So, but when we're thinking about kind of over even the last decade, consumers have come to trust more forms of e-money, like such as PayPal and Venmo. Kind of Bitcoins are kind of a new form of e-money. They're not made by a government or a company, but like they're a decentralized system of linked computers. And so they can be traded for other currencies on websites. And then some websites, they even accept Bitcoin as a form of payment. So when we're thinking about should they be included in the money supply, right now they're not, but if they continue to grow in popularity and usage, maybe they should be. So just another thing to think about when we're thinking about measuring money in the U.S. So as far as how do banks themselves create money in 14.3, overall, again, they're playing a pretty critical role in the money supply as a whole. There's more money held in checking accounts than there is actual currency in the economy itself. And then so somehow money is being created by banks. So essentially, their banks are generally profit-making private firms. Some of them are small, but some of them are among the largest corporations in the country. So obviously their activities are going to be designed to allow and enable themselves to make some sort of profit. So I did go ahead and put a link to this fun little YouTube video about the goldsmith to kind of give you, again, like some historical context and further explanation on kind of how the banking system itself came into existence. And then I'll also be uploading a couple more videos done in conjunction with my dad, who has quite a bit of experience working in a family-run bank. So now we're just going to go ahead and quickly define some of these terms that we'll be talking about in a couple of those other videos. But we need to think about the idea of banks themselves. They have to keep reserves. So what reserves are, their deposits that a bank keeps as cash in its vault or on deposit with the Federal Reserve or the Fed. So obviously a bank's not going to keep enough deposits on hand to cover all of its deposits. That's how the bank's going to be able to make a profit. They're going to be lending out or investing money that's deposited in it. So banks in general, they still have to keep some cash available for their depositors, right? So they do this through a combination of vault cash and then deposits with the Federal Reserve. And so banks in the US, they're actually required to hold a certain amount of reserves. So the required reserves, these are reserves that a bank is legally required to hold based on the checking account deposits. And so to determine what the required reserves are, they have what's called a required reserve ratio, which is the minimum fraction of deposits banks are required by law to keep. As reserves. So just an interesting note, as of actually a few days ago, March 26th, the required reserve ratio is actually 0%. So again, during this time, with all of the consumer and firm concern about like the direction in which the economy is going, the Fed went ahead and lowered the reserve ratio to 0%. And then finally, overall, banks might choose to hold excess reserves, so they may choose to hold reserves over the legal requirement. So we'll kind of get into, again, the numbers behind how banks are creating money in another video. So now let's talk a little bit about the Federal Reserve System itself. So overall, we've described in the US, banks are going to keep less than 100% of deposits as reserved. So kind of what that's known as is the fractional reserve banking system. And it's a system shared by nearly all the companies. So we have the fractional reserve banking system. So it's where banks keep less than 100% of deposits as reserves. So when we're thinking about that, just like in the video, what it talks about is what happens if depositors simultaneously lose confidence in a bank and then all try to withdraw the money, right? What that's known as is a bank run. And then if a lot of banks experience bank runs at the same time, a bank panic actually occurs. And so what happens is central banks, like the Federal Reserve, they can actually help prevent bank runs and panics by acting as a, quote, lender of last resort, promising to make loans to banks in order to pay off the depositors. So having that assurance that the Federal Reserve is going to act like a lender of last resort kind of breaks the negative feedback loop. So essentially, as far as the establishment of the Federal Reserve System, in the late 19th and 20th centuries, the U.S. experienced several bank panics, obviously where everyone was going to the bank and trying to withdraw their money and the banks didn't have enough. And so in 1914, the Federal Reserve System was started. And what the Fed did is they actually made loans to banks called discount loans, and charged them an interest rate called the discount rate. And so when the Great Depression hit, a lot of banks were hit by bank runs because, people were very just concerned about having money in hand. And so essentially what the Fed did is they refused to make any discount loans to a lot of banks. And so a bunch of banks also failed. And so what happened is after the Great Depression, Congress established the FDIC, the Federal Deposit Insurance Corporation, and they insure the deposits in many banks. And so the government guarantee essentially has helped to limit bank panics. So they're still possible, obviously, bank runs are, but overall, the FDIC has tried to, mitigate some of that fear that banks would run out of deposits. Back in 1913, Congress itself divided the country into 12 Federal Reserve districts. And so I don't have a map here, but there's 12 districts kind of separated out. And so, but the real power of the Fed is in Washington, D.C. with the Board of Governors. And so 8 times a year, the Federal Open Market Committee, they are responsible for conducting open market operations and managing the money supply overall in the U.S. And then how kind of the Fed itself manages the money supply, what they do is they do monetary policy. So we kind of briefly touched on monetary policy in the last chapter, but we're just going to go ahead and define that as the actions the Fed takes to manage the money supply and interest rates. So what they're trying to do is pursue macroeconomic objectives, again, trying to mitigate, swings between recessionary periods and expansionary periods to try to get us to long-run equilibrium. And so in order to manage the money supply, the Fed's actually going to use these three monetary policy tools. So we have three monetary policy tools. So we have open market operations, we have the discount policy, and then we have reserve requirements. Open market operations, that's the buying and selling of U.S. Treasury securities by the Fed to control the money supply. Okay, so what happens is if the Fed wants to increase the money supply, what they're going to do is actually buy securities. If they want to decrease the money supply, they're actually going to sell U.S. Treasury securities. As far as the discount policy goes, the discount rate, again, is the interest rate paid on money banks borrow from the Fed. So we have the discount rate is the interest rate paid on money banks borrow from the Fed. And so if you lower the rate, you're going to encourage borrowing. And then vice versa, if we raise the rate, we're going to discourage borrowing. So I'm not going to write that just because I don't have enough room. And then lastly, as far as reserve requirements goes, again, we're going to be altering the reserve ratio in order to affect how much banks are actually required to hold as deposits. So if we actually reduce reserve requirement, you're going to increase the loans and the money supply. Obviously, if we increase the reserve requirement, you're going to decrease loans and the money supply. So again, we're going to see video worksheets for kind of some practice on calculating and further understanding, what the reserve requirement does, and then also kind of how that affects how much money is in the money supply. Finally, the last thing that I just want to touch on briefly is the idea of the quantity theory of money. This was actually formalized by Irving Fisher through the quantity equation, which was m times v equals p times y. And so m in this case, that was the money supply. V is going to be velocity of money, which we'll define in a second. P is our price level. And then Y is our real output / GDP. So kind of historically looking back in the 16th century, what happened is Spain actually sent gold and silver from Mexico and Peru back to Europe. And then they turned the gold and silver into coins, which increased the money supply. And then prices in Europe overall rose kind of during those years. So people were kind of able to make a connection between kind of how much money was actually in circulation and price level overall. So again, Irving Fisher actually formalized the relationship using this. And so essentially when we're measuring the money supply itself, we're going to be measuring it with M1. The price level is going to be with the GDP deflator. And then our level of real output or real GDP is there. So P times Y itself would be our nominal GDP because, again, it's real GDP adjusted for changes in price. So we're able to see what nominal GDP is, and then we're also able to calculate what V is as well. But we don't know kind of like, are we always going to get the same answer? And so essentially what the quantity theory of money does, it kind of asserts that kind of obviously subject to measurement error, we would get the same answer. And so quickly, let's define what the velocity of money is. So the velocity of money, it's the average number of times each dollar in the money supply is used to purchase goods and services included in GDP. And then overall, the quantity theory of money, this is a theory about the connection between money and prices that assumes that the velocity of money is constant. So overall, we can also kind of look at real GDP itself, and it's been relatively consistent over time. So kind of based on QTM, there should be a predictable and positive relationship between annual growth rates of inflation and the growth rates of the money supply. So if we're assuming that both real GDP and the velocity of money are both constant, then M is going to equal P. So if we increase the money supply, it's going to cause an increase. Wow, okay, that was unexpected. An increase in price level. So that about sums up chapter 14. Again, I'm going to upload a few more videos that kind of goes into a little bit of calculation as far as the reserve requirement, discount policy, kind of creation of money goes as well.